Lecture 19: Price Action During Trends. In this lecture, you will learn about price action and the dynamics of power between bulls and bears during strong trends. Analyzing how price reacts to bull pairs dynamics will help you to understand and even to predict price actions during trends. I will begin this lecture with defining trends. There are two types of trend: an uptrend, which is also called a bull trend, and a downtrend, which is called a bear trend. As you can see here, bull trend can be defined as a series of higher highs and higher lows, and can be recognized on your chart when the price begins in the lower left corner of your screen and ends in the higher right corner without big swings in between. On the other hand, a downtrend is a series of lower lows and lower highs, and can be recognized when the price begins in the upper left corner and ends in the lower right corner. Trend is the expression of market sentiment. Hence, it is always advised that you trade only in the direction of the ongoing trend. Probably you have heard the following phrase many times, which is "the trend is your friend," and if you do not follow it, then you are fighting the sentiment of the market, and the result of this fight is obvious: you will be crushed. A trend usually begins with a breakout from a pattern, usually a breakout from a trading range or a trend line. In this chart, the price was stuck in a trading range, which represents uncertainty among bulls and bears. Once the price broke the resistance line to the upside, bulls had the upper hand. They become more confident about the direction of the market, and they bought heavily, sending the price up very fast. Beginner traders are always trying to predict the beginning of new trends. This is what they think about most of the time. If the market is in trading range, they expect every test of a trend line to be a breakout into a new trend. And if the market is in an uptrend, they interpret each pullback as a reversal signal to begin a new downtrend. Look at the bull flag here. I bet it has trapped many beginners who thought it was a reversal, while technically it was an obvious trend continuation setup, as you have learned in section 2. Beginners are obsessed with market transitions, but the fact is that the market resists changes and always trying to do what it was doing before. A successful breakout changes the mood of the market and consequently the confidence of bulls and bears. Breakouts change the dynamics of power between them. If bulls feel more powerful and more confident about their trades, it will be the beginning of a bull trend. On the other hand, if bears are more confident, it will be the beginning of a new bear trend. A breakout is the sign of this shift in power. But this sign alone is not enough for you to trade the new forming trend. To reduce your risk, you need a confirmation, and a confirmation can be at least one higher high in case of a bull trend or one lower low in case of a bear trend. Where a conservative entry point for a newly forming bull trend would be at this first higher low. It always represents the best low-risk entry point for trading uptrends. Regarding downtrends, the perfect entry point is at the first lower high, which represents low-risk shorting setup. Every trend, whether it is a bull or a bear trend, usually goes through three distinctive phases or stages. The first stage comes immediately after the breakout, and it is characterized by a price movement that is fast with a very tight channel. Additionally, it also has very few and shallow pullbacks. Look at this newly formed uptrend and notice the early phase of it. It clearly looks steep without significant pullbacks. Usually during this early phase, no second chances is given for regular conservative traders. And it is hard to rely on signals during this period because they usually are very poor trend continuation signals. Because the market is trying to keep with trend traders out. Here is another example showing the early phase of a downtrend. Most traders will miss this early opportunity of trading this downtrend because the price stays most of the time near the extremes, and they feel that this trade is so risky to be taken. Therefore, only aggressive traders take advantage of this early phase because the other traders are afraid. The fact that might shock you is that the big traders make most of their money in Forex market by exploiting the fear of other traders. When you are afraid, they become aggressive, and then what you are afraid of becomes true. For example, when you are afraid that the market might go up, then it's more likely that it will go up. The second stage of most trends expresses itself with less momentum than the first stage. As you can see here in the second phase of this uptrend, channels become wider and pullbacks become somehow deeper. Traders are still believe that the trend is strong, but because it's now exposed and obvious, the market tries in this phase to trick traders by forcing with the trend traders to close their positions and trying to trap counter trend traders. During this phase, the market offers many second chances to ride this trend for conservative and smart traders. Signals for a trend continuation becomes more obvious and less risky for patient traders. But now the tactics are different. Entering the market at extremes is no longer profitable. Traders need to be patient to locate a good entry point, and they need to wait for a pullback that at least tests the previous high in case of uptrends or previous low in case of downtrends. The third and the last phase of the trend is characterized by growing uncertainty among traders, accompanied by a price action, which is represented by deep pullbacks and the formation of quite strong resistance or support levels. During this phase, the price enters some sort of a nearly horizontal channel and trading range. The chance for trend continuation or trend reversal becomes almost 50-50, and usually the market will enter a wait and see mode, seeking a trigger for the next path of the price action. Bear in mind that during this last phase, most signals are fake because the price is attracted to the center of the newly forming trading range. Most breakouts, whether they are for trend reversal or trend continuations, are born to fail, trapping with them many traders. This is the end of this lecture, and in the next lecture, you will learn more aspects about trends and how to trade them professionally.